Mr. AG here. Asian guy bringing you the complete picture. Silver just crashed another 15%. The white metal hit as low as $73.57 per ounce during Asian trading. Gold sank below $5,000 to $4,971. The volatility that hammered precious metals last weekend has returned with a vengeance. And now the biggest banks in the world are releasing their forecasts for where silver goes next. But here's the thing, they cannot agree. Not even close. Citi says silver could hit $150 within 3 months. UBS says silver will average $56 this year. JP Morgan predicts $125 by year end. Bloomberg Intelligence suggests silver could fall all the way to $50, making 2026 a quote down year end quote. The divergence between these forecasts is absolutely massive. And today I'm going to break down every single one of them, explain why these institutions are seeing such different futures, and give you the complete picture so you can make your own informed decision. Before we go any further, let me be crystal clear about something. I do not sell courses. I do not sell signals. I do not sell mentorships. I do not have any paid products of any kind. I share this analysis because so many of you have messaged me saying this content helps you understand what is really happening in the markets, see both sides of every situation, cut through the noise, and make more informed decisions. That is why I do this. I give you the raw data. I show you what the bulls are seeing and what the bears are seeing, and I let you decide. Now let me get into exactly what is happening, because the next few weeks could determine the direction for the rest of the year. Drop a comment right now. Where are you watching from? What country? What city? I want to see how global this community has become. Are you watching from Asia, Europe, North America, South America, Africa, the Middle East? Let me know in the comments. And while you're down there, tell me which bank forecast you find most credible. Citi's $150, UBS's $56, JP Morgan's $125, or Bloomberg's $50. I want to see what this community thinks. Let me know. Now let me break down what happened today and why it matters. Silver prices collapsed more than 15% on Thursday morning as the volatility that hammered precious metals around last weekend returned. The white metal hit as low as $73.57 per ounce during Asian trade. A brief bounce toward $90 earlier in the week has completely evaporated. We are now roughly 23% lower over just 7 days. Let me repeat that. 23% down in 7 days. That is not a normal correction. That is a crash. And it is happening in real time. Tim Waterer, KCM chief trade analyst, explained what triggered this move. The dollar received a new lease of life with the Kevin Warsh nomination as Federal Reserve chief. The currency has been able to keep making forward progress. Traders are more circumspect now on gold in light of recent extreme volatility. That is a direct quote. The dollar rose to a near 2-week high on Thursday, making greenback-priced gold and silver more expensive for international buyers. When the dollar strengthens, commodities priced in dollars become more expensive for everyone else. That reduces demand, and reduced demand means lower prices. Christopher Wong, a strategist at OCBC, described the broader dynamic. Sentiment has turned soggy across most asset classes, including precious metals, cryptocurrencies, and regional equities. Losses are feeding into one another and creating a self-reinforcing feedback loop amid thin market liquidity. That phrase, self-reinforcing feedback loop, is exactly what we are seeing. Silver falls. That triggers stop losses. Stop losses trigger more selling. More selling pushes prices lower. Lower prices trigger more stop losses. And around it goes. When liquidity is thin, when there are not enough buyers to absorb the selling, every sell order has an outsized impact on price. That is why we are seeing 15% moves in single sessions. Let me ask you something. What time is it where you are right now? Morning? Afternoon? Evening? Late night? Drop it in the comments. I'm always curious to see when people are consuming this content. Are you watching before markets open to prepare for the day? Are you watching after the close to understand what happened? Let me know. Now here is something critical that analysts are highlighting. This sell-off reflects a perfect storm of thin liquidity, profit-taking, and renewed risk aversion rather than any shift in fundamentals. Let me repeat that because it is important. Rather than any shift in fundamentals. The selling is not because the thesis for silver has changed. The selling is because of positioning, leverage, and market mechanics. Many traders are still unwinding leveraged positions and meeting margin calls after January's rally. A firmer US dollar ahead of major central bank meetings has further dampened appetite for precious metals. This is mechanical selling, not fundamental reevaluation. Ole Hansen from Saxo Bank reports that heavy selling resumed in futures markets when prices failed to break resistance near $90.50. A large short position by a Chinese investor and softer pre-holiday demand have compounded the drop. We talked about that Chinese investor in a previous video, Bian Ximing. The trader who made $3 billion on gold and then bet against silver right at the top. His short position is one of the factors pressuring prices right now. Julius Baer's Karsten Menke warns that the market has yet to find an equilibrium, and violent swings will persist until speculative excess is flushed out. That is an important warning. Violent swings will persist. This is not over. The volatility is not done. Until the speculative excess is fully unwound, expect more dramatic moves in both directions. Deutsche Bank strategists point to billions of dollars in outflows from silver exchange-traded funds since October. Billions of dollars. That is institutional money leaving silver ETFs. When institutions sell their ETF holdings, the fund managers must sell the underlying metal. That creates mechanical selling pressure on the physical market. This is not small investors panic selling. This is large institutional money taking profits and reducing exposure. Now let me get into what the banks are actually forecasting, because this is where it gets really interesting. The divergence between forecasts is absolutely massive. Banks remain sharply divided over silver's prospects. A Reuters poll of analysts released this week found the median forecast for 2026 has jumped to around $79.50 per ounce. That is up from $50 in October, but still well below January's highs above $120. So the median view is that silver will trade around $80, but the range around that median is enormous. Let me start with the bullish banks. Citi remains bullish, arguing that persistent supply deficits could catapult silver back toward $150 within 3 months. $150 within 3 months. That is essentially a doubling from current prices in 90 days. This view is echoed by Lotus Asset Management, which sees triple-digit prices by year-end. JP Morgan expects silver to end the year near $125 per ounce, supported by a multi-year supply deficit and resilient industrial demand. ANZ and OCBC analysts argue that forced selling is largely over and that support around $75 to $80 should hold unless the dollar surges again. Now let me give you the bearish banks. UBS is more conservative, projecting an average price around $56 this year and $58 by the fourth quarter. That is a dramatically different view than Citi's $150 prediction. Bloomberg Intelligence. Mike McGlone takes an even more bearish view, suggesting the gold to silver ratio is likely to revert and silver could retreat toward $50, making 2026 a quote down year end quote. Former JP Morgan strategist Marco Kolanovic warns that if speculative froth unwinds further, silver could fall back toward $50. Let me put this in perspective for you. Citi says $150, Bloomberg says $50. That is a 3-to-1 divergence between major institutions analyzing the same market with access to the same data. How is that possible? How can sophisticated institutions with billions in research resources come to such dramatically different conclusions? The answer is they are weighing different factors differently. The bulls are focused on supply deficits and structural demand. The bears are focused on speculative excess and mean reversion. Both are looking at real data. They just disagree on what matters more. About 60% of you watching right now are not subscribed to this channel. If this analysis is helping you understand what is really happening, if it is giving you perspectives you are not getting elsewhere, consider hitting subscribe. I do not do hype. I do not do fear-mongering. I give you the complete picture from all angles and let you make your own decisions. If that approach resonates with you, subscribe. Now let me address the industrial demand situation because this is a critical factor in the debate. Kunal Shah, head of research at Nirmal Bang Commodities in Mumbai, said something that every silver bull needs to hear. The industrial demand has vanished at the higher levels. Most of the industrial buyers have stopped buying silver, and even solar panel producers in China are looking for alternatives. That is a direct quote. Industrial demand has vanished at higher levels. Solar panel producers are looking for alternatives. This is significant. A major part of the bull case for silver has been industrial demand, particularly from solar panels. Silver is used in photovoltaic cells. The green energy transition was supposed to drive massive silver demand. But if prices got too high and manufacturers started finding substitutes, that changes the equation. Menke from Julius Baer sees signs that industrial demand is cooling as solar module makers seek cheaper materials and jewelry demand softens. However, here is the counterargument. Industrial users consume close to 60% of global output, and mine supply has fallen short of demand for 7 consecutive years. 7 years of supply deficit. That is structural. That does not change overnight. Even if industrial buyers pause at elevated prices, the underlying supply-demand imbalance remains. When prices pull back, those industrial buyers return. They need the metal. They are just waiting for better prices. And here is something else that is getting overlooked. Physical demand looks resilient. At the start of the month, silver in Shanghai traded nearly $40 above Western prices as strong Asian demand and supply constraints kept premiums high. $40 premium. That is massive. That tells you physical buyers in Asia were willing to pay significantly more than Western paper prices to secure actual metal. Dealers report that jewelers and manufacturers use this week's weakness to secure physical metal. While paper prices crash, physical buyers are stepping up and accumulating. Quick question for the community. How many of you own physical silver versus paper silver like ETFs or futures? Drop it in the comments. I am asking because the dynamics are completely different. If you own physical metal, you are not subject to margin calls. You're not going to be forced out by volatility. You can hold through the storm. If you own paper products, you are exposed to all the mechanics of forced liquidation that are driving these crashes. Know which category you are in. Now let me give you the complete bearish case because you need to hear both sides. The bearish case is substantial and needs to be taken seriously. Silver has crashed more than 23% in just 7 days. That is not normal. That is a rout. The bounce to $90 failed. Resistance held. And prices crashed right back down. The technical picture is damaged. Multiple banks are predicting much lower prices. UBS says $56. Bloomberg says $50. Kolanovic says $50 if speculative froth unwinds. These are not random bloggers. These are major institutions with serious research capabilities. Deutsche Bank data shows billions of dollars in ETF outflows since October. Institutional money is leaving. When the big money leaves, prices fall. That is how markets work. The dollar is strengthening. A stronger dollar is a headwind for commodities. If dollar strength continues, precious metals face continued pressure. Industrial demand is cooling at elevated prices. Solar manufacturers are looking for alternatives. Jewelry demand is softening. The demand drivers that powered the rally may be weakening. Geopolitical tensions are potentially easing. Iran and the US have agreed to hold talks in Oman. Trump called his discussions with Xi very positive. Shah from Nirmal Bang said, if you remove geopolitical tensions and the de-dollarization trend, metals have little room to run. The speculative excess has not been fully flushed, according to Julius Baer. Violent swings will persist until it is. If you're trying to catch the bottom, you might be early. Being early in a volatile market means you take losses before you see gains. Banks cannot trade this volatility. Market makers are stepping back. Liquidity has dried up. In a low liquidity environment, prices can overshoot dramatically in both directions. There is no floor because there is no depth. Bank of America's Nicholas Westermark expects volatility to remain elevated, but says he does not anticipate another 30% crash unless another speculative bubble forms. But that also implies the risk of another bubble and crash remains on the table. That is the bearish case. It is comprehensive. It is data-driven, and it comes from major institutions. Now let me give you the complete bullish case because the bears are not telling the whole story. The bullish case starts with fundamentals. Mine supply has fallen short of demand for 7 consecutive years. 7 years. That is not a one-time blip. That is a structural deficit. Deficits eventually get priced in. The market cannot remain in deficit forever without prices adjusting upward to balance supply and demand. Citi explicitly says persistent supply deficits could catapult silver to $150 within 3 months. JP Morgan expects $125 by year end. Lotus Asset Management sees triple-digit prices by year end. These are not fringe voices. These are major institutions with bullish views. Physical demand remains strong. Shanghai premiums of $40 above Western prices tell you Asian buyers are accumulating aggressively. Dealers report jewelers and manufacturers buying the dip. The physical market is telling a different story than the paper market. When there is a divergence between physical and paper, eventually they reconcile. Either paper rises to meet physical or physical falls to meet paper. Given the supply deficit, the former seems more likely over time. The crash was driven by mechanical factors, not fundamentals. Thin liquidity, profit-taking, margin calls, leverage unwind, dollar strength. None of these represent a change in the underlying thesis for silver. The sell-off reflects a perfect storm rather than any shift in fundamentals, according to analysts. When the storm passes, the fundamentals reassert. ANZ and OCBC analysts argue that forced selling is largely over and support around $75 to $80 should hold unless the dollar surges again. If forced selling is exhausted, the mechanical pressure dissipates. What remains is the fundamental picture, and the fundamental picture still shows supply deficits. Industrial demand has not disappeared. It has paused at elevated prices. That is different. When prices pull back, industrial buyers return. They need the metal. Close to 60% of global output goes to industrial use. That demand is structural. Solar installations continue to grow globally. Electric vehicle adoption continues. Electronics manufacturing continues. The applications that use silver are not going away. Silver gained over 140% in 2025 before this correction. Even after a 23% crash in 7 days, silver is still massively up from where it started. Violent corrections are normal in major bull markets. They shake out weak hands. They transfer assets from speculators to long-term holders. And then the bull market resumes. Standard Chartered said structural drivers remain intact, and they expect a rebuild to the upside. That is a major institution saying the bull case is not broken. The correction is painful, but it does not invalidate the thesis. Trump said there was not much doubt the Fed would lower rates again. Lower rates are bullish for precious metals. Metals do not pay interest. When interest-bearing alternatives pay less, holding metals becomes more attractive. If the Fed cuts rates, a major headwind disappears. Here's a question I want you to really think about. If you were bullish silver at $120, are you more bullish or less bullish at $73? The thesis has not changed, only the price has changed, and the price is now 40% cheaper. If you believed in the fundamentals at the highs, the fundamentals are even more attractive at the lows. Unless your thesis has fundamentally changed, lower prices represent opportunity, not danger. Let me share something Bank of America said that I think frames this well. The Western market expects volatility to remain elevated, but does not anticipate another 30% crash unless another speculative bubble forms. What does that tell you? It tells you the extreme downside risk is limited in his view. Volatility, yes. Another 30% crash unlikely unless we rebuild speculative excess first. That is a cautiously constructive view. Now let me talk about what I'm watching over the next several days and weeks. Because the picture should become clearer. Watch the $73 to $75 zone. That appears to be the support level that analysts reference. If silver holds above that zone, the worst of the selling may be over. If silver breaks decisively below 73, we could see a move towards 65, or even the $50 level that bears are targeting. Watch the $90 resistance level. That is where the bounce failed. For any recovery to be credible, silver needs to reclaim $90 and hold it. Until that happens, rallies remain suspect. Watch the dollar index. The dollar's direction may matter more than anything specific to silver right now. If the dollar continues strengthening, commodities face continued pressure. If the dollar stalls or reverses, a major headwind disappears. Watch ETF flows. Deutsche Bank highlighted billions in outflows. If outflows continue, mechanical selling continues. If outflows slow or reverse, that selling pressure disappears. Watch Shanghai premiums. If physical premiums in Asia remain elevated, that tells you real buyers are accumulating despite paper price weakness. If premiums collapse, that would be more concerning for the demand picture. Watch industrial buyer behavior. If solar manufacturers and electronics makers step back in at these lower prices, that confirms demand is real and was just paused at elevated levels. If they continue seeking alternatives, the demand picture changes. How many of you have been stacking silver for years versus just getting interested recently? Drop it in the comments. I am asking because your time horizon changes how you should interpret all of this information. If you have been accumulating for a decade, this volatility is just noise on your long-term chart. If you just bought last month, this is your first real test. Know which category you're in, 3 key takeaways, and then we are done. Number 1, silver crashed another 15% on Thursday, hitting $73.57 during Asian trading. We are now down 23% in just 7 days. The bounce to $90 failed at resistance and prices collapsed back down. The selling reflects a perfect storm of thin liquidity, profit-taking, and renewed risk aversion rather than any shift in fundamentals. Mechanical factors drove this crash. Leverage unwind, margin calls, ETF outflows, dollar strength. Not a change in the underlying thesis. Violent swings will persist until speculative excess is flushed out, according to Julius Baer. The volatility is not done. Number 2, banks are wildly divided on where silver goes next. Citi says $150 within 3 months. JP Morgan says $125 by year end. UBS says $56 average this year. Bloomberg Intelligence says $50, making 2026 a down year. The divergence is massive because banks are weighing different factors. Bulls focus on 7 years of supply deficits and structural industrial demand. Bears focus on speculative excess, dollar strength, and industrial demand pausing at high prices. Both are looking at real data. They disagree on what matters more. You need to decide which thesis you find more credible. Number 3, physical demand remains strong despite paper price crashes. Shanghai premiums of $40 above Western prices indicate Asian buyers are accumulating aggressively. Dealers report jewelers and manufacturers buying this dip. Mine supply has fallen short of demand for 7 consecutive years. The structural deficit does not disappear because of a price crash. Eventually, fundamentals reassert. Standard Chartered says structural drivers remain intact and expects a rebuild to the upside. ANZ and OCBC say forced selling is largely over and support around $75 to $80 should hold. The question is timing. The bottom may be in, or there may be more pain before recovery. Position according to your time horizon and risk tolerance. Let me leave you with this thought. When major institutions disagree this dramatically about the future, it tells you uncertainty is genuinely high. Nobody knows for sure whether silver goes to $150 or $50. Anyone who tells you they know for certain is lying to you. What you can do is understand both cases, evaluate the evidence, assess your own time horizon and risk tolerance, and position accordingly. If the bulls are right about supply deficits and structural demand, buying at $73 will look brilliant in a year. If the bears are right about speculative excess and mean reversion, buying at $73 will look premature. The honest answer is, we do not know which scenario plays out. We can only evaluate probabilities and position for our own circumstances. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frame. Are you trading on daily charts or investing on decade-long theses? Your answer determines how you should interpret everything I've told you. Plan and position accordingly. If you are over-leveraged, volatility will force you out, regardless of whether you are ultimately right about direction. If you are positioned appropriately with no leverage and a long time horizon, you can weather this storm. But if you are new and do not have a plan, environments like this will destroy you. Invest with logic, not emotion. Use your brain. Drop your thoughts in the comments. Where are you watching from? Which bank forecast do you find most credible? Are you buying this dip or waiting for more clarity? I read every comment, and they help shape what topics I cover next. The volatility is not done. More moves in both directions are coming. Stay sharp. Stay informed. Make decisions based on data and logic, not fear and emotion. This is MSAR AG, Asian Guy, bringing you the complete picture. I will see you in the next one.